Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Last week was a big week for the tech stocks, and it was all thanks to Afterpay. The $39 billion sale, or potential sale at least, of the buy now, pay later market leader to US giant Square lit a fire under the tech sub-index on the ASX. I wanted to have a look at how the technology stocks are travelling now and where the opportunities might be. Elise Kennedy is the Vice President of Equity Research at Jarden Group. Elise, welcome back to Fear and Greed.
Thanks for having me on the show, Sean.
So, what did you reckon of the Afterpay deal?
Look, I'd previously talked about Square potentially being a player in the space, but I hadn't thought that it would be by inorganic means and taking out one of the largest market leaders in the space with Afterpay. I think it's clear, though, from the earnings call that the two corporate leaders, they've been liaising for a period of time and they've got a shared vision of what they want to create, and the culture, they seem to be quite aligned there. And, if you look at where the stocks traded following the deal, it looks as though investors of both Afterpay and Square received it positively. So our first take there is, as long as they can get that regulatory and shareholder approvals and a few other caveats that they mentioned, it's likely that that'll go ahead. Less inclined to think that there's probably going to be another bidder, just given, the alignment, and it seems those conversations have gone for a while.
What do you think of the price? And I say that with the view that not that long ago, Afterpay was trading above $150 and maybe it was a little overvalued at that point. But is it a fair price, do you think?
I think the fairness really comes down to, at the end of the day, you're still participating in the upside. So if you believed the journey of Afterpay, it's not as though you're foregoing that higher price of $160, as you mentioned, it hit historically. You've now got a bigger company because of their merge with Square that if you can hold that stock, actually might see your value of that go higher than that share price. I think that's where investors are largely thinking that, look, it's an okay deal.
Fair enough. Now, look, some of the other buy now, pay later stocks have done well as a result. Zipco's the obvious one. You keep an eye on Zipco and Cecil, I believe.
Yeah, we do look at those two stocks. So Zip aims to be your first payment choice everywhere, every day, and they have a high amount of transaction frequency because they've rolled out this Zip Everywhere product that's a short-term loans. And also you just look at the trading multiple. They trade on around 9 times next 12 months EV sales, whereas you look at Afterpay, it was on 24 times and the deal's even higher. So I think that that's more of our value play that we watch. Cecil, it's a smaller operator. Even again, it doesn't have a global footprint like Zip does. They're North American focused with a longer term strategy for Europe and other emerging markets. I think for us with those guys, the challenge is the size, especially when you've got really big players now of Afterpay and Square, and you've got Apple in the space, you've got PayPal. It just becomes increasingly hard for those domestic only players to really sell their value proposition to merchants of extra customers.
Yeah, I often wonder about, the Slidits, OpenPay, PayRight, there's a bunch of them, and Klarna, of course. It's getting very crowded in that sector.
Yeah, I have to agree with you on that. On the back of the M&A activity that we saw with Afterpay, the whole buy now, pay later space went up. But if you step back and you think logically about it, you just had one of the strongest competitors in the space just get stronger with the tie-up of one of the largest fintechs in the space. So it's actually getting harder for some of those smaller players to compete, that it seems counterintuitive to me that all that buy now, pay later space went up. So it's increasingly crowded and competitive, especially if the deal goes ahead, that from our standpoint, we think you'd probably prefer to reach those with global footprint rather than those smaller players.
Now, of course, the tech market here has done really well in the last couple of years, and the tech index, which you're going to correct me here, I'm sure, but it's probably 18 months to 2 years old. I don't know. But it certainly seems to have done well. What about some of those other names like WiseTech Global and Altium?
Yeah, so the tech space, it has done well and is increasingly contributing to the overall index, as you've noted. So there's a few other stocks in there, as you mentioned. So WiseTech, logistics software, tapping into a large addressable market of around $21 billion. We view them as ability to grow their revenue organically around 20% over the next 5 years, driven by increasing module usage, global rollouts, some of those acquisitions that they made adopting that CargoWise Enterprise Platform, which is the name of their software. And also just into this result, because they are reporting over this reporting season, freight trade volumes, which they're leveraged to, are at all-time highs. So they've had a really strong recovery, and that should be a benefit for WiseTech. And then Altium, they already pre-guided in their result. The challenge we see for that stock, even though it is a tech stock, is again going back to that addressable market. It's, in our view, a bit too small at 1.2 bill to sustain the multiple that it currently trades on. Essentially, you think if you have to deliver over 20% revenue growth to justify the 16 times EV sales multiple that it's on, but to do that, it means that they essentially have to have about 100% of their market.
Yeah.
So it doesn't really make sense where valuation's trading, and it hasn't pulled back from a bid that they got. So it's still quite expensive. I think, it's good company, good management, but it's just valuation that's hard to stack up there.
So that one might be a bit small, but one who is no longer small, has done a great job in recent times, is Xero.
Yeah, look, that stock's from little Kiwi space to
Incredible.
now a large contributor to the overall index and continuing to grow. It is one of our top picks here at Jarden. It's got a $74 billion runway for growth, and adoption of accounting software is still less than 20%. And they've shown their ability to really compete in that space, especially even against some of the incumbents. You think when they came to Australia, we had MYLB, which is now taken private. They were a very strong, formidable competitor, and yet with that, Xero was still able to take a strong foothold in the market. And then they're also now pursuing other areas of growth like platform revenue, and they just released the other day that they're going to start charging for their app store. Again, that should just drive the combination of more subscribers, higher pricing with those add-on cross-sell products, and helpful for the margin as well because you're selling to the existing customers.
Yeah, I mean, I always think of Xero, and you mentioned MYOB, Intuit, QuickBooks. It seems like there's enough room for almost all the players in that one.
Well, that's what we think as well. Everyone says, do you worry about the competitive landscape of Intuit and a few of the others? And I think if you look across, the landscape of devices and software that you use, for example, you've got people that like Apple better than Android. I think of this space similarly in that, you don't need to have a one-player eats all model. It can be a healthy oligopoly.
Stay with me, Elise. We'll be back in a minute. My guest this morning is Elise Kennedy, Vice President of Equity Research at Jarden. Now, Elise, what about the property plays or the online property plays, REA and Domain? Now, I worked at Fairfax for a long time and had a lot to do with Domain, so it's always close to my heart, though I must say REA has done a cracking job in that space. What do you think of those two?
Yeah, they are very well-held household names, excuse the pun there, but we are positive on the housing market as a whole, just driven by the view of house price growth, and that tends to drive the listings volumes, which is, you think, more listings on there, the more money these guys can make, because that's how they make their revenue, particularly as you start to see, or you might get stamp duty changes. Again, that's something that bodes well on listings volumes because it should increase housing turnover. The only caveat, I think, to those stocks right now is in lockdown. We don't know when that ends. The market's holding up well so far. Consumer sentiment's still positive, but, we just don't necessarily know where that's going to pan out longer term.
Okay, so going through all those, Xero is almost your top pick, I think you said. Why is the Australian tech sector so much better now than it was 5 years ago? Or have I got that wrong?
They're definitely making a bigger contribution. I think it's just a matter of the adoption curve. So, if you think about early stage technology in the environment, if you go back, say, several years, you weren't necessarily using your computer and a lot of the add-ons that you might be using today. So I think what we're seeing is us, from our standpoint as consumers, really starting to adopt technology, use it, and therefore pay for it. That has, as a result, seen these companies start to make larger contributions. And also a lot of them as well have started to really get a foothold globally and find that playbook. So I think that we're still, yes, it's larger than it was historically, but I still think we've got a real long way to go with the tech sector. And you'll see from Australia, we're putting a lot of investment into growing that space.
Okay. What about, retailers come to mind, the e-commerce plays. I'm not sure whether they're quite tech stocks, but they seem to be heading towards tech stock status. And Kogan.com, Temple and Webster, I know that they still sell products, but I always think of them as tech stocks almost.
Yeah, I have to say that, there is some elements that's tech to them, especially the utilization of some of the data and ensuring that they can use AI to tailor their offerings to you as an individual. I do, though, note, however, often they're challenged to some extent because they're often localized. You think you've got Amazon, it is global, but it does have a stronger footprint over in the US. COVID's more domestic here. So tech plays, but there's probably a few other unit economics that make them not as high valuation as perhaps some of those others that can easily roll out their model globally.
Fantastic. Elise, thank you very much for talking to Fear and Greed this morning.
Great to be on the show. Thanks, Sean.
That was Elise Kennedy, Vice President of Equity Research at the Jarden Group. This is a Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.